Okay, again, I'm Allison Powell, and tonight we're talking about public policy, particularly economic policy. If you follow us on Twitter or Instagram at Think5able, you'll be able to be informed of all of the different streams that we have available to you. And you can also subscribe on YouTube and find lots of other great resources. So today in this stream, we're going to be talking about liberal and conservative economic ideologies. We'll talk about fiscal and monetary policy. I also want to look at the AP US government exam in 2008, FRQ, I believe it was number 1, that we'll be looking at. So this right here that I've provided for you just shows you that what we're going to go over tonight is definitely covered with the AP curriculum, and it's supposed to be covered. So again, we're going to talk about liberal and conservative economic ideologies, which is in this essential knowledge content part. And then we're also going to be talking about Keynesian and supply side policies and the difference between fiscal and monetary policy. So at one point I was teaching both AP Macro and AP US Gov, but the year before I taught US Gov, I only taught AP Macro at the time. My macro kids were so pumped because in that year in 2008, this question came up on the Gov exam about economic policy. And so all my econ kids were like, this is great. But the kids who didn't have econ that year and only had Gov that year, they were on the struggle bus in that year because their teacher hadn't gone over this stuff. So it's a good thing that you're here tonight to go over it. But also, if you're in AP Macro, also, this is going to be kind of like a cake episode or stream because you go over that in AP Macro as well. All right. So liberal economic ideology basically has 5 goals. But all of these 5 goals revolve around the government getting involved in the economy when is necessary or when they feel it's necessary. So one role of government is to redistribute income to reduce income inequality. So in our country, we have an increasing amount of income inequality. So that means that there's a real divide between the haves and the have-nots. So liberal economic ideology would say that we need to take some of the income from the wealthiest and redistribute it to those who don't have as much. Okay. Number 2, that the government should get involved in regulating businesses for the public welfare. So for safety concerns, to make us healthier, those sorts of things. So, for example, every restaurant in your town probably, hopefully, is inspected by the health department to make sure that they're putting out food that's safe for you to consume. The FDA regulates food and drugs on the national level. So, like prescription drugs that are manufactured are regulated by the FDA. The Department of Transportation regulates the safety of cars. They mandated that all new cars have to have airbags, and way back when they mandated that they had to actually have seatbelts. When my parents were growing up, there weren't seatbelts in cars. And that just seems crazy to me. But it's partially because governments have involved themselves and required that of car companies. Now, it is true that many car companies would probably put those safety features in because the consumers would demand it on their own. Okay. 3, that the government provide some public goods and private essential goods. So if you take AP Micro, there will be a big discussion, hopefully, about the difference between private and public goods. For our need, we don't really need to distinguish those things. But, when you think of public goods, what do you think of? You think of roads, bridges, the things that the public all uses that not one individual pays for. Public goods like public schools, they're technically not a public good, but it does have a role in both our economy and our society. And so liberal economic ideology favors more spending in those areas. Liberal economic ideology thinks that there sometimes are market failures. So if you take AP Micro, you have a whole unit about how sometimes markets fail and what governments can do to fix those failures. Well, I'm not going to get into the technical definition of market failures, but one market failure is pollution. So when businesses pollute without, cleaning up that pollution, they're basically exacting a cost onto all of society or the community at large without incurring the cost. And economists see that as a market failure, and governments can come in and tax that business or require them to clean up some production. So liberal economic ideology would say the government needs to step in to correct those market failures. But number 5 is the one that we're going to talk about the most tonight, and that is that the government should intervene to stabilize the economy through fiscal and monetary policy. So we see this a lot, okay? We saw it in the Great Recession that we had in 2007, 2008, but we also saw it in the Great Depression. We know that FDR, through the New Deal and Congress, him acting in concert with Congress, put out a ton of fiscal stimulus to get us out of the Great Depression, and it worked partially. World War II also stimulated the economy, and that extra government spending probably got us out the most because we spent a ton of money on it. Okay, but we'll talk about fiscal and monetary policy and how that can stabilize the economy. Well, conservative and to a greater degree, libertarian economic ideology says basically that the government needs to stay out completely. And when we wrote our Constitution, or before that, when we declared our independence, Adam Smith wrote a pretty important document called On the Wealth of Nations. And there he is talking about a free market economy. And so right as he is putting forth that document, that is when our nation was finding itself and working out its own economic and political doctrines. So it heavily influenced the economy that we have today. So Adam Smith says that the government should stay out of the economy's way because basically the economy will regulate itself through self-interest and competition. He said that self-interest motivates us. In fact, he has a quote. Let me think of it, see if I can pull it from my brains. It's not from the butcher, the baker, or the brewer that we expect our dinner, but from their regard to their own self-interest. So he's saying there that, we don't go to the baker and say, please, can I have some bread? The baker bakes bread so that way he can sell it to you and make some money. And that motivates him to make the best product possible. Here's a little known fact, though, about Mr. Adam Smith. He did not always expect his dinner from the butcher, the brewer, or the baker. He lived with his mom, and his mom took care of him. And so that's kind of an interesting to me and funny anecdote, because he's saying that self-interest motivates you, but yet his mom gave selflessly to him. And so if everyone were motivated completely by pure self-interest, and we're not talking about how altruism has a positive effect on our psyche, if we're leaving that out, it's just kind of interesting because his own mom wasn't completely self-interested, since she helped him out a lot. Anyway, so he said that self-interest motivates us, but competition regulates the market through an invisible hand. So the government doesn't need to put its hands on the economy like some persons from yesteryear. Anyway, so the government doesn't need to control the economy. An invisible hand will kind of take care of it, because if I'm competing with you, say we both have lemonade stands, we don't need the government to come in and make sure that we are brewing our lemonade to the best standards and to make everybody safe, because we are both competing for business. And so it is in my interest, my self-interest, to make the very best product possible, and in your interest to make the very best product possible. So us competing with one another will bring about high quality and low prices without the government needing to be getting involved. It is true that market-style economies have the most, generally without market failures, have the most efficient outcomes. So really, it's between the conservative and liberal economic ideology is really about values. Do you value equity or do you value efficiency? Efficiency is important because if an economy is efficient, it can produce more, which means that the average standard of living is greater. So this is an important value or goal, but it is at odds many times with equity goals. And so it really depends on which one you value more as to which ideology you ultimately have. So Adam Smith and other libertarians, they don't really see the need for much government. However, government is needed even within their ideology. Government is at least necessary to help protect private property. Because if you have a whole lot of crime and you have a breakdown of law and order, then that is not going to produce a stable economic system. And you're not going to want to go produce a whole bunch if, it just gets stolen from you. So government is needed to enforce the rule of law. But many libertarians don't really see the need for government much above that. Police and, national defense. So conservative ideology, government stay out. Liberal economic ideology, government intervene. Any questions about liberal or conservative ideology in the chat room? Is this one Keynesian? Good. So Keynesian economics would be the liberal economic ideology, and we'll talk about that one in a minute. So thanks for the question. Yeah, we'll be talking about that, and that's definitely on the liberal end. If you're in AP Macro, you may know, and you should know at least at some point, about the classical ideology, and that aligns with the conservative ideology. Thanks for the question. Okay. So we said that one role in the liberal economic thought, one role of government is to stabilize the economy. So the government can do this through fiscal policy. And this is enacted through the budgeting process. So in the chat box, if you know who initiates the budget, okay, that's the first question. Who initiates the budget? So who kind of comes up with the budget plan? Okay, who passes? Who makes alterations to that plan and votes and passes that plan? And then who ultimately approves the budget? So I'm talking about like branches of government. Good. Okay, so Congress votes on the budget and the president signs it. So very good. But generally, the president can initiate their ideas for the budget. Now, that doesn't mean that that's what Congress is going to adopt, and very rarely would they ever adopt exactly what the president proposes. They make lots of changes. That's how they get reelected, is they put lots of things in there that help them in their districts. Okay, so again, the budget process generally is begun with the president in that he comes up with a plan, puts forth things that he wants to spend money on. Then the Congress makes changes and passes it, and then the president would sign it or veto it, and then they'd have to start the budgeting process over again. Okay? Well, through this budget process, the budget is made up of tax revenue. That's the money that comes into the government, and government spending. What they dole out. The money that they spend to build roads and bridges, and pay teachers. Now, some of this is also local government and state government spending as well, right? But the things that the government spends money on minus its taxes, or the revenue that it comes in minus government spending, that makes up your budget. And you have a deficit if your spending is greater than your taxes, and you have a budget surplus if your taxes are greater than your government spending. So the government can manipulate the levels of taxes and spending in order to change the direction of the economy. So let's say we're in a recession. Let's say we're in a depression, like the Great Depression. Then what the government can do is they can cut personal income taxes, and then they can increase their own spending in order to boost consumer spending. So like if they cut your taxes, you got more cheddar in your pocket, right? You go out and spend it. If the government increases spending, what that means is they're hiring people. Okay? I don't know if it's fictitious or not, but there's an idea that, during the Great Depression, they hired people to dig ditches and then fill them back in. Well, even if that was a nonsense job, which I agree labor could be used more efficiently, even if that's a nonsense job, it does stimulate the economy, because that person then has a paycheck that they can then go out and spend in the economy. And then that brings in more revenues to businesses and so forth. It actually has a multiplier. If you take AP Macro, you learn all about the multiplier. So one of the questions that came up was, is this Keynesian? That is a picture there at the bottom of John Maynard Keynes. So he really thought that the government should get involved. And he is the one that basically came up with this idea of expansionary and contractionary, to a lesser degree, fiscal policy. The government should step in a recession or a depression by cutting taxes and increasing government spending in order to stimulate the economy. So when that would happen, again, this is the business cycle in a recession or a depression phase. Contractionary fiscal policy, you're going to increase taxes and decrease government spending. So you kind of think, why would you do that? And really, politicians have a disincentive to actually increase taxes and decrease government spending. Ask George H.W. Bush, right? Read my lips, no new taxes. That's the reason why he raised taxes, and that's why he didn't earn a second term, or part of it. So when the government increases taxes, this takes money out of people's pockets. Or if they cut government spending, that means jobs will be cut. So again, that takes money out of people's pockets. They're less likely to spend. And that sounds like an awful thing, and it is to those people. However, at that point, it's kind of necessary to get inflation down, because when they would enact this is because inflation is a problem. Demand is basically outstripping the natural supply. So that's going to kind of occur in expansions and booms. So what fiscal policy does is it kind of levels off this business cycle to make the highs not so high and the lows not so low. This middle picture here kind of shows a zoomed in version of the economy. But when we zoom out, what you see here, this is the graph on the right, is from 1990 to 2014. When you zoom out, you see that we don't have like super high and super low lows, that we actually have this upwards economic trend of economic growth. And this is not just the United States, but this is the world's GDP. But the problem is when you zoom into that year and GDP drops by a whole lot, I mean, it's pretty rough in that little dip. But again, if you zoom out and you think about the long-term effects, generally economies will rebound. Okay, and that is what supply-siders and classical economists would have you think about, this bigger picture. Okay, this should be covered right here. The federal budget should be covered in Unit 2 when you talk about interactions with the branches, but I thought I'd bring it up here just so that you know that the budget is made up of tax revenue, and we get revenue from various places, and spending. It's also really important for you to review the difference between mandatory spending and discretionary spending. Mandatory spending is spending that has to occur because we've passed laws in the past that like basically already spend the money. So Social Security was set up, and it said if you're this age, you get this amount of your income basically returned to you when you retire. Medicare and Medicaid, those are also entitlement programs that say if you meet these requirements, then you are entitled to the benefit. So those are things that have to be paid out. What we do notice is that mandatory spending, because of Social Security and Medicare and the cost of medical care with Medicare and Medicaid, because those things are growing, mandatory spending is growing so much that it's difficult for our government now to make choices about how they'll spend their money on other things like defense and education and things that we just want to spend money on that we want to make choices about. Discretionary spending is kind of becoming more limited due to the mandatory spending from entitlement programs such as Social Security and Medicare and Medicaid. Also, because our debt has gotten so huge, the interest payment on the debt is growing too, and that's something that is also, it's not listed here as mandatory, but it is. It's a mandatory spending item. Okay, they kind of left that out of the mandatory part, but it is. Okay, let me know in the chat box if you have any questions about fiscal policy. So again, fiscal policy is something the government does to change taxes and spending to change the direction of the economy. Monetary policy is policy enacted by the Federal Reserve. And the Federal Reserve, just to let you know, the structure of the Federal Reserve. Federal Reserve is mostly a private bank. However, some of the very top people that are in charge of the Federal Reserve are appointed by the president. But these appointments aren't like the president's cabinet that he can just hire and fire at will. The chairperson is nominated by the president and confirmed by the Senate, just like all appointments. But the chairperson has a 4-year term. And so the president can't just fire him. This time it's him. His name is Jerome Powell. He can't just fire him anytime he wants. Okay. The Board of Governors is a 7-member group and the chairperson is basically usually chosen from that Board of Governors. Board of Governors is also in the upper echelon of people who make monetary policy. And they have 14-year terms. Although they are appointed by the president and confirmed by the Senate, they have a very long term. So this kind of insulates the Federal Reserve from politics. And that can be a good thing because you want economic policy not to be driven by politics, but what is good for the overall economy. You want experts to be able to put their expertise to work, right? And to make the right choices, because this can really change the economy dramatically. Monetary policy can. So again, supposed to be insulated from politics. Donald Trump, just like he does with everything else, has tweeted about the Fed. This tweet is from 2019. However, I think just last week he criticized the Fed for not cutting interest rates more in the wake of the COVID-19. So they dropped interest rates 0.5%. So let's talk about why and how they drop interest rates. So the Federal Reserve is in control of the money supply. They can increase the money supply or they can decrease the money supply to change interest rates. If they increase the money supply, this basically allows there to be more money out there for banks to more freely lend to people. And since banks have a greater supply of money, the interest rate will go down. They do this to expand the economy. So this is called expansionary monetary policy, the increase of the money supply to decrease interest rates. Because if interest rates go down, then you are more likely to go out and buy a bigger house or a better car. You're going to spend more money because the loan is basically cheaper for you to do so. Contractionary monetary policy puts the brakes on an overheated economy. So they would decrease the money supply to then increase interest rates. So that's monetary policy enacted by the Federal Reserve, insulated somewhat from politics, supposedly, changes the interest rate to change the direction of the economy. Okay. So another part of the course and exam description is that you need to know about what supply side economics is. So supply side economics is, instead of stimulating demand, which is what fiscal and monetary policy does, it stimulates or contracts how much you want to spend out in the economy. Instead of doing that, we look at businesses, the supply side of the economy. We look at producers and how much they're producing. If producers produce more, that means that prices will go down. That makes sense, right? If there's greater supply of a product out there with the same amount of demand, then prices will lower. And so that is supposed to help not only the producer, but also the consumer. So the business kind of trickles down their savings along to the consumer. Also, when they're producing more, they're going to be employing more people. So supply side economics is referred to as trickle down economics, or Ronald Reagan, who's pretty much like the god of supply side economics, his vice president, George Herbert Walker Bush, he called it actually voodoo economics, which kind of implies that it's fake, right? So yeah, even his own vice president kind of disagreed with this economic idea. But again, you're going to stimulate investment by granting businesses tax cuts, and then they're going to pass along that tax cut to consumers with cheaper prices. And also, they'll employ more people. Okay. So classical economics is kind of similar. It's also kind of one of that conservative or libertarian ideas that you don't need to intervene in the economy. The government does not need to intervene, because wages will adjust to economic conditions in something called the long run. Now that graph there, that might scare you. If you're just in government and you're not in econ, you're like, oh, what does that mean? And even if you're in macro, you might be like, my teacher put that up on the board, but I still don't know what it means. Okay, don't worry, you're not going to have to worry about that on the AP government exam. However, I just wanted to show you, just in case you are in macro, this exam or that picture there, that graph, shows what happens from the short run to the long run and how the economy kind of levels itself off or fixes itself without the government getting involved. So again, we said John Maynard Keynes is kind of opposed to this idea. He did not think that this happens. He does not think that the economy will recover on its own, or at least it's going to take a really long time. Okay, because remember, this idea of classical economics is that the economy will fix itself in the long run. So Keynes says, well, in the long run, we're all dead. I mean, that's like his famous quote, in the long run, we're all dead. So he was unwilling to wait for the long run to happen. He wanted the government to intervene at that point. Okay. So I'm basically done with my lecture part. This is the FRQ from 2008. You have to define fiscal policy. Okay, so in the chat box, if you can define fiscal policy, that'd be good. Anybody? Define fiscal policy. Now, wait a minute. And if everybody would just look through A through E, kind of pause here, come up with some ideas. Good. So I've got an answer here that is good. The fiscal policy is how the government changes the economy by changing taxes, also by changing government spending. Good. So perfect. Let's see if that gets the credit for A without also saying government spending. So I read that. Oh, I thought I had the answers up. That should be okay. That should get you the credit for A. But I would include there and government spending. Okay, so how does the executive branch influence fiscal policy? What do we say that the executive branch does to influence fiscal policy? What role does the president play? Because that's the executive branch, well, part of the executive branch, right? So, good. The executive branch can push their ideas onto Congress when making the budget plan. They can also sign, or he can sign the budget into existence. Good, very good. Point. All right, part C. So actually, you're gonna kick this exam's booty. All right, so 3. Describe one significant way that the legislative branch influences fiscal policy. Well, you kind of already did it in that you said that the Congress passes the budget, all right? D, define monetary policy. Monetary policy. Good. So how the Federal Reserve changes interest rates to impact the economy. Spot on. Good. Why is the Federal Reserve given independence in establishing monetary policy? This one's probably a little trickier, so we'll just kind of chat about that. So one, I looked at the answer choices or the scoring guidelines right before I came on. And one, you want experts, again, making these policies because they have such significant impact. So you kind of want them to be insulated. You want to have experts. Sorry. one second here. Because they're experts, they make economic policies, can make economic policies efficiently. Also, why does the Congress give any power or authority away? They do this quite frequently, right? So the bureaucracy, which the Federal Reserve's not really within the bureaucracy, but within the larger bureaucracy, they allow the bureaucracy to have decision-making authority that they would already do. So they abdicate this responsibility to a different branch because it's a difficult decision-making thing about changing interest rates. It's a difficult decision to make, okay? Also, another point says that you could just say that it removes politics from monetary policy decision-making. All those 4 things that I just listed are all given points on the AP exam, okay? Well, thank you guys for your participation tonight. If you have any questions, please let me know in the chat box. I really do appreciate it. And I wish you well on the AP exam.